Our next guest believes the Fed will calm inflation fears, setting the stage for another record run. Joe Lavorgna, the aforementioned Lavorgna, the chief economist of the Americas at Natixis. He served as White House chief economist in the Trump administration. Joe, welcome back to CNBC. Good to see you.
Thank you. Great to be back, Melissa. Thank you.
So you think that this is like nirvana for the markets?
It's nirvana for the markets. And my good friend Steve Leisman was onto something. The Fed is going to keep rates extremely accommodative. It would be a big mistake, Melissa, if Jay Powell was to signal any bringing forward of tightening. The Fed's MO has been time and time again to get inflation higher, and now they want to run it hot for a period of time to get inflation higher so that it offsets the fact that it's basically missed its target for the last 12, 13 years. If that means higher equity prices and tighter credit spreads, so be it. But I would be very surprised if the Fed comes off of this super dovish approach. If they do signal that tightening is occurring sooner, if they do signal that we're getting a taper sooner, that is going to lead to a big hiccup in markets, higher rates, lower equity prices, wider spreads, and that will work against what they're trying to do, which is really get what will probably be the best year for GDP since 1983.
Hey, Joe, thanks so much for joining us tonight. This is Bonawyn. A quick question. If the contrarians get what they want, and there is some language that indicates that we will have some tapering or raising and change in policy, do you think we'll see this translate in the equity market or the credit market? Which do you think will be the leading indicator in that regard?
It will happen both at the same time. The thing is, if we look at inflation, we've had 2 months in a row now where your core inflation rate has disappointed to the downside. Over the last 3 months, your core CPI annualized is under 1%. Over the last year, it's only 1.2%. So yes, you have higher inflation expectations, but if the Fed all of a sudden brings forward the timing of even the taper, equities and credit will both react simultaneously, and it will be in a negative direction. That's not to say that the world will end or the economy will be weak, but if the Fed is really trying to run the economy hot, as Jay Powell has said time and time again, then they need to keep this policy with the pedal to the metal. And only after a period of time, when we've actually seen inflation, measured inflation, move higher, can we start to, I think, guess, okay, maybe they're going to ease off the gas a little bit. We're just no way there. We're no way near there yet.
Hey, Joe, it's Tim. So Nirvana, you said 6 to 9 months of Nirvana. So let's go to that great rock album, Euro Rocker, 1991, Nirvana. Song number 5 is called Lithium. And lithium is usually used to treat bipolar disorders. This market without the Fed is basically been, I should say, has been led to bipolar by the Fed. How do we get out of this dynamic, or is it the Fed's problem to worry about?
I wouldn't say it's bipolar, Tim, simply because if you look at bond yields, they've been negative for over 2 years. This is a global story, which the Fed is obviously a very important part of. But we're still looking, as you know, at a tremendous recovery in earnings. We had a V-shaped boom last year. I talked about it when I was in the administration. That's continued. We've got a lot of momentum. Certainly this year, we've got additional stimulus, which has certainly been a huge prop for growth. And the earnings that you're seeing on the equity market are going to be somewhere up 185, 190. I mean, it's going to be a massive recovery from where we were before. So I wouldn't say it's bipolar. I wouldn't say this is just Fed engineered. I mean, certainly there's a lot of market intervention, but that's been the case, Tim, with these central banks for a long time. So I wouldn't necessarily focus on the Fed. The question is, when will rates naturally rise because the demand for capital is so strong for new investment that rates are forced to go higher? And we're not at that point yet. Maybe late this year, early next year, but not yet.
Joe, great to see you. Thanks.
Thank you, Melissa.
Joe Lavorgna of Natixis. Quickly, Dan Nathan, to button this conversation up. Jerome Powell comes out tomorrow, says, again, we're not thinking about, adds a thinking about even raising rates. Do yields stay put? Have we seen the top for now?
Well, first of all, that's exactly what he's going to do. They're not going to surprise anybody, and so no one thinks that's going to happen here. And I think Guy has been right that the rates are just, at least in the 10-year, is going to continue to float up towards that 2%. But I'll just say it again. If you're looking at it through the lens of the stock market, if you're looking at it again through the lens of the V recovery, what have we done here over the last year or so? What have we done over the last 12 years or so. I mean, it literally has been a transfer of wealth, right, from sovereigns into the corporate sector here. So the stock market, of course, is reflecting this, but rates are never going meaningfully higher, maybe above 2.25%. I don't know, maybe 2.5%. If you really think about, look at how much debt there is all over the world to continue to keep this stuff afloat. So to me, I just think that maybe you see 2% and equities don't even care.
All right.
Shepard Smith here. Thanks for watching CNBC on YouTube.